Buenos dias. I am very honored to be speaking to all of you today. And as I was thinking about discussing private equity post-COVID, I couldn't help but think about how every region, organization, and person who's attending this conference has certainly been affected by the human suffering that has occurred as a result of the COVID pandemic. However, with all the tragedies, there were also great heroics and sacrifices made by individuals like healthcare workers and frontline workers whose efforts were to help those less fortunate than them during this crisis. And of course, we are grateful to all of them. And I think we all finally have a lot to be hopeful for and grateful that there have been effective vaccines developed and they are being distributed, albeit sometimes slowly. But I am hopeful, and I think we all are hopeful, that over the next several months, we can defeat COVID and live our lives in a much more normal way. From an industry point of view, there has been tremendous changes. And if you go back to March, I think that all of us would have predicted a much worse environment, not just for private equity, but for all investing. And I think we've all been shocked by how quickly the markets rebounded. And so, all said, I think we have a lot to be thankful for. And as I guess the first big change in the industry, having watched the video, the Neuberger Berman video, is since COVID, I've been wearing a tie a lot less often. So that's the first trend that I'll talk about. And now to get a little bit more on the serious side, let's open with the first slide. I think in order to really examine how COVID has affected the markets, we need to start by looking at history. And this slide shows the historical global private equity returns versus the public markets. And as you can see by this slide, the private equity average pooled returns have outperformed the MSCI World Index almost over any reasonable period of time. And the first quartile has vastly outperformed the public markets. Now, when we think about these returns, I think people also want to understand is what has been happening to private equity returns over time. What are the trends as increased competition has occurred and capital keeps flowing into the private equity markets? This next slide shows the median, first, and lower quartile performance of private equity by vintage year through 2017, really the last mature vintage year that has meaningful data. And you can see that even in the face of increased competition and capital flowing into private equity, the returns have been stable and even increasing over the last 15 years, which is almost counterintuitive. So what do we think are behind these increasing return numbers? Well, we attribute it to three major trends. First, like all asset classes, private equity has benefited from lower interest rates, general favorable market and economic conditions for more than a decade. Secondly, and this is very important for private equity investors, private equity firms have been shifting their focus on industries and companies with higher secular organic growth and stronger free cash flows and are more resilient to economic downturns. This was accelerated by COVID. And in fact, in 2020, really only businesses that were unaffected by COVID or even benefited from COVID were invested in. The third trend, and we think the most important trend, is that private equity firms have shifted away from financial engineering and trying to buy things cheap. And they've shifted to creating value in their portfolio companies by implementing very aggressive strategic and operating plans to accelerate revenues and earnings growth. And this was also accelerated by COVID as firms looked to ways to insulate their businesses from the detrimental effects of the pandemic. Now, favorable market conditions and innovations by private equity firms have clearly produced great absolute and relative returns as seen in the first two slides. But I think the question on all of our minds is, can this continue? This brings us to the elephant in the room and the biggest concerns of all the LPs that we speak to, and probably the biggest concern for all of you, whether you're an LP or a GP, who is attending this conference. As you can see in this graph, the valuations in the US and Europe, as measured by EBITDA multiples, have risen significantly and arguably are at all-time highs. So we do think that valuation risk is the biggest risk that private equity investors face in today's market. Of course, P is not alone, as almost all asset class valuations, including public equity market valuations, have also risen significantly. So to better understand how investors should think about valuation risk and the future prospects of private equity, I think we need to dig a little deeper underneath these numbers to understand what the future may have in store to us. As I mentioned earlier, private equity firms have been shifting their focus towards higher quality, higher growth companies in faster growing industries. And in fact, almost all the businesses invested in by private equity in 2020 were either not affected by COVID or even were positively affected by COVID, as COVID accelerated secular trends that favored companies with strong business models, and it exposed companies with weaker business models. In many cases, we think COVID might have accelerated these trends by 5 to 10 years. And you can see it in consumer behavior and in the behavior of companies around the world. Now, at Neuberger Berman, we are one of the largest co-investors in the world. We look at hundreds of deals every year. In the last several years, we've invested over $3 billion a year into co-investments, partnering with some of the best GPs from around the world. The chart below is based on data from our co-investment business. And if you look at these two pie charts, you can see that in 2015, only 48% of the companies that we invested in had base case revenue growth of greater than 5%. In 2020, 100% of the companies we invested in had growth greater than 5%. And even shocking to me, 53% of the companies had growth rates of greater than 10%. So part of the increase in valuations that you saw on the previous slide is because private equity firms are investing in faster growing companies that are in faster growing industries, companies and industries of the future. And these companies and industries not only currently have high valuations in the public markets, but we would argue their growth rates and their resiliency warrant higher valuations relative to other companies. So maybe the run-up in valuations aren't quite as big as they look when you just look at the raw numbers. Let's take a closer look at this in the next slide. This slide uses the technology industry as an example of one of the high growth industries that private equity firms have been significantly increasing their participation in. The slide depicts the increased focus on technology in fundraising, in private equity deal activity, and in exit activity. In the middle of the slide, you can see that in 2020, 26% of all private equity transactions were in technology. And that's up from 14% in 2010. And when I started in the industry in 1986, it was probably close to zero, if not zero. Tech used to be seen as an industry that was not made for private equity investing, as private equity investors focus on mostly value buyouts, slower growing companies that needed margin improvements. Now, the other interesting thing is when you look at returns, the tech industry has had the highest returns to private equity investors over the last decade, with the average realizations being almost 3 times the original investment. Now, these private equity trends towards higher growth companies certainly partially explains some of the increase in valuations that we see in the private equity markets. But we believe that private equity firms' ability to add value to companies that they invest in is what truly sets private equity apart from other asset classes in its ability to mitigate valuation risk and earn returns that are not correlated to the public markets. Private equity firms have invested heavily in strategic and operating experts and resources, bringing them into their firm and having them work with their portfolio companies to drive revenues growth, earnings growth, and to increase returns in their portfolio companies. The best private equity firms partner with management in the portfolio companies to develop very aggressive strategic and operating plans that focus on accelerating the earnings growth of the underlying companies. And they provide these companies with guidance and resources to help them successfully implement these plans. Some of these strategies include add-on acquisition strategies, margin improvements, geographical and product expansions, and other forms of strategic and tactical repositioning. These plans not only create value away from the market, but they significantly mitigate valuation risk. This is a huge advantage of private equity investors over public market investors. Private equity investors control the companies that they buy, so they can implement these aggressive plans and also align the interest of investors more closely with the board and the management teams of these companies. I mean, if you think about it, simply put, if private equity firms can double the earnings in a portfolio company over a 4 to 5 year period, even if exit multiples contracts, even if markets go down, you are still likely to make good returns. Let's focus on one of the major tools that private equity firms are using today, and that is add-on acquisitions as a major driver that we see actually in most of the transactions that are being completed today by private equity firms. These charts show that as a percentage of buyout activity, that add-on acquisitions have gone from 43.2% in 2002 to 71.7% in 2020. These add-on M&A strategies play to the very core expertise and strengths of private equity firms. And it allows them to enable their portfolio companies to increase market share, gain scale and scope, and increase the operating margins and profits of their companies through the synergies that they can make happen when they make these acquisitions. So we've talked about the direct private equity market and the high valuations and how private equity firms are focusing on faster growing industries and making changes in these businesses as a way to cope with the current high valuations. But that doesn't mean that every area of the private equity market has high valuations. And in fact, at this point, I would like to shift to some of the current trends in the secondary market. There are a couple very important trends occurring in the secondary market, and these trends have been accelerated by COVID over the last 12 months. The first trend, as depicted in this slide, is that pricing in the secondary market as a percent of net asset value has been declining over the last 3 years and is well below the 10-year average. And we believe that this pricing in the secondary market represents a very attractive investment opportunity for investors. And some of the volatility that was caused by COVID led to more selling in the marketplace as investors rebalanced their portfolios to fortify them to withstand some of the negative effects of COVID. The second trend in the secondary market, we believe, is one of the most important trends occurring in the private equity markets today. And this is the advent and growth of what the industry refers to as GP-led secondaries, which represents a large opportunity for investors. In this slide, GP-led transactions now represent 44% of the secondary market. A decade ago, this market basically didn't exist. And you can see with COVID, the large increase, although transaction volume was down because the end of the first quarter and second quarter, the volatility froze the secondary markets up temporarily, although they rebounded very strongly at the end of the year. You can see that GP-led transactions as a percentage of total transactions increased significantly. So we believe that structured correctly, GP-led transactions have very strong alignment with the general partners and the LPs. It also gives existing LPs an option for liquidity if that's what they want. But they also have the option to roll into the new deal. These GP-led transactions can also be structured to provide portfolio companies with capital for future growth. And this was essential during COVID and is one of the reasons that GP-led transactions became even more popular. These transactions essentially allow general partners to extend their ownership in their very best portfolio companies that they believe can continue to generate superior returns for LPs under their continued ownership, management, and guidance. Also, because the GPs knows these existing portfolio companies very well, the risk of underperformance or downside surprises are greatly reduced. And combined with the strong alignment with the GPs, we believe that GP-led secondaries are an excellent opportunity for limited partners to earn superior returns with less risk. Now, we have spoken in some depth about our overall positive views on private equity's ability to overcome the high valuations in this marketplace, certainly relative to other asset classes, which we believe will continue to lead private equity to outperform the public markets. We also spoke about opportunities in the secondary markets, but of course there are risks. And I want to spend a few minutes on some of the major risks that our LPs have communicated with us. The one risk that I am sure is that all of you are worried about is the amount of capital that is being raised by private equity firms. Simply put, is there too much money chasing too few deals? The bars on this graph show the annual fundraising since 2006 by the size of the funds. And the line on this graph shows the number of funds raised annually. And although 2020 fundraising was down slightly from previous years, it's still close to being a record year and is well above the 10-year average. Now, if you look at the underlying numbers, the fundraising was skewed towards larger and more established funds, as those were the funds that were able to raise money more easily during COVID because investors were more comfortable giving capital to funds that were already established and well known. But also as a result of this, 84% of the fund raised in 2020 met or exceeded the target of their fundraise. That is up from 68% in 2015. This means that the market did have a focus and a bias towards quality and experience. But of course, this also made access to these funds much more difficult for LPs. So to understand whether the large amount of private equity capital that has been raised in the last 3 years is a big problem, I think we need to look a little bit closer at the data and the supply and demand of investments in the private equity market. This slide shows the global private equity uncalled capital, or what we refer to in the industry as dry powder, capital available for new private equity investments. And you can see in 2020, dry powder reached $970 billion, having grown at 8% per annum over the last 10 years. By any measure, this is a very large number. And I think to understand the ability of private equity firms to put this capital to work and generate good returns, we need to put it in perspective. This slide shows the average private equity dry powder has risen in the last few years, but still it is well below the last downturn. And from this perspective, we don't think there's great concern or cause for concern. But even so, it's a lot of dry powder. And this amount of dry powder, to really understand whether or not it can be efficiently and effectively invested, we somehow have to look at the opportunity set in the marketplace. What this slide shows is private equity global dry powder as a percent of the global equity markets in 2010, 2015, and 2020. And although the percentage has increased, it is still tiny compared to the global equity markets, less than 1%. Do all of you believe that greater than 1% of public companies around the world could benefit from private equity ownership? For us, the answer is an easy yes. We do believe that at least 1% of public companies could benefit from being owned by private equity. Having spoke to lots of public CEOs, I'm also very confident that much more than 1% of the public CEOs would agree that the long-term focus of private equity and the more flexibility around embarking on aggressive strategic and operating plans, there are many CEOs who would think that they would be able to do that more efficiently as a private equity-owned company. Of course, the opportunity set goes way beyond public companies, as there are tens of thousands of private companies around the world that could benefit from access to private equity capital and the benefits of private equity ownership. So now, having addressed the amount of dry capital in the market, let's shift to the remaining top concern of our LPs, and that's the current rise in interest rates around the world. In this slide, we just focus on the 10-year Treasury yield as a barometer of where interest rates are going and where they've been heading. And this slide shows a large increase in the 10-year Treasury yields over the last few months. You can also see the bump in the forward curves from November 2020 in the green to the current forward curve in the red. The good news is that this is partially due, this bump up in the forward curves is partially due to higher expected GDP growth and a stronger recovery around the world. And in general, this is very good news for private equity portfolio companies, as it's an opportunity for them to grow quicker, their revenues and their earnings. The risk is that a significant rise in interest rates will put pressure on private equity companies' balance sheets and have a negative effect on valuations. Neuberger Berman's perspective on this is that interest rates will rise in line with the current forward curves, albeit with some short-term volatility. We believe that these increases in interest rates are mostly already priced into the market and reflected in the current valuations that we're seeing in the public and the private markets. So we are not expecting a deep decline in valuations in the short or medium term. Even with the expected increase in interest rates, they are still very low on a historical basis and still very favorable for private equity investors overall. However, because forecasts can be wrong, and the risk is certainly out there around interest rate and valuation risks, we are still focused as an investor on private equity firms and transactions where the private equity firms that are buying the companies focus on companies with strong organic growth rates, strong free cash flows, and resilient business models. And then they form, with the management teams, strategic and operational plans to improve the companies that they invest in as a way to mitigate the risks associated with any steep increases in interest rates, lower valuations, or other negative surprises that may occur. So this is Neuberger Berman's view. What do most limited partners think? As you can see from this slide, that 77% of LPs expect private equity performance to meet or exceed their benchmarks. And 81% of LPs are currently at or below their private equity allocations. And this results in 84% of limited partners expecting to maintain or increase their allocations to private equity over the next 12 to 18 months. And this brings me to my last slide. This slide is a survey of general partners and their views on which geographic markets present the best opportunities currently in 2020, represented by the blue bars, and then prospectively in 2025, represented by the red bars. For 2020, it appears to me that the respondents are being highly affected by COVID and the current crisis. And as a result, they are favoring the more mature private equity markets like the United States, Europe, Canada, and the United Kingdom. In general, we think respondents saw these markets as safer in times of a global crisis, less volatile perhaps, and more apt to lead the recovery and bounce back more rapidly from the effects of COVID. However, for 2025, I think you see the true baseline sentiment of investors that reflect a more normalized view of global secular trends. And you can see that for their view in 2025, there was a steep decline in the number of respondents that saw the mature private equity markets as the best opportunity. And developing private equity markets had the biggest increase in the number of respondents that saw them as the best opportunity, reflecting the long-term favorable demographic trends and economic growth rates in these regions. You can also see that South America has had one of the steepest increases, or has one of the steepest increases in the number of respondents who see the region has to have some of the best opportunities in the medium and the long term. We have been investing in the region for years, and we also have a very positive medium and long-term view of the regions in the Pacific Alliance. And we believe that we'll be increasing our allocations to these markets going forward, and that they will be exciting and profitable markets for our investors to participate in. And with that, I want to thank all of you for your time today. I believe we're going to open it up to questions if there's time. Thank you again. And next time, I hope to be with you in person.